Hey YouTube, what is up? My name's Dylan and welcome back to my YouTube channel. So today's video we are going to talk about the 401k, the traditional 401k I might add, because there's actually a new type of 401k that's becoming popular, the Roth. But today we're going to talk just about the traditional, kind of give you guys all the ins and outs, make sure you fully understand it before investing in it. So let's hop right in and I'll introduce you guys to the traditional 401k. So the traditional 401k, what the heck is it? So it's an employee-sponsored retirement savings account. So an employer sets this up for its employees that they can contribute money to on a regular interval. So it's considered a qualified plan, which means it gets special tax benefits, which we all like, because none of us like paying taxes. And it's also a defined contribution plan, which means the amount of money in the account is made up by the contributions of you, the person who's putting in it. However, there is such a thing as employee match, which is one of the greatest benefits of the 401k program. So we're going to talk about that later in the video. So in a traditional 401k, an employer is automatically going to withhold money from your paycheck based on how much you tell them to before it's subject to any federal income tax. What they're going to do with that money is they're going to put it into this 401k account for you to invest into various investments. So as you grow, you're going to watch your investments grow over time. You're not going to pay any taxes on them now. You're not going to pay any taxes on the gains in the account, but what you are going to do when you turn retirement age or when you pull those out in the future, you are going to have to pay income taxes on those, ordinary income tax, because it's going to be treated as income. So basically you're deferring your tax till later in life when you withdraw those funds. So the biggest advantage of a 401k is the tax advantage. So you get the tax benefit today. So for example, if you have a $50,000 salary, you put $10,000 in a 401k, when you get your W-2 from your employer at the end of the year, it's going to say your taxable income is only $40,000. So that's the biggest benefit of a traditional 401k, is the tax benefit you get right here, right now, today. So how much can you contribute to this traditional 401k plan? So the IRS allows individuals to contribute $19,500 per year. That's a huge amount. It's the most of any individual retirement account. So that's the first benefit. And actually, if you're over 50, they give you what's called a catch-up contribution. So you can actually contribute an extra $6,500 on top of the $19,500 to help yourself out if maybe you got started investing a little later in life. So the biggest two advantages I see so far with the traditional 401k is tax deferred. Don't pay tax now, we'll pay tax later. So we go ahead and deduct that amount, whatever we put in, from our taxable income, and we can actually deduct up to $19,500 from our taxable income if we max out the full yearly contribution to the traditional 401k. So when do you get the money? In a traditional 401k, there's only one thing you have to have satisfied to receive what's considered a qualified distribution, meaning you get the money out of your account and you don't have to pay penalties and you don't have to pay taxes. And that one thing is you're over the age of 59 and a half. If you're under 59 and a half and you need to access those funds, you're going to be subject to taxes and penalties, which you probably don't want to pay. So I would think twice and hard before actually wanting to pull money out of this 401k account early. All right, so you've decided you want to do it, you need the money, I understand it. So are there exceptions to be able to pull money out of your 401k early? And in fact, there are. However, 401ks are very complicated types of retirement accounts because each employer sponsors an account, so each employer may allow certain things. However, generally speaking, hardship withdrawals are allowed from a retirement account, such as a traditional 401k. And the IRS defines a hardship withdrawal as an immediate financial need. So if you have an immediate financial need and you can prove that, and your employer may ask for documentation, you may actually qualify to pull money out of your 401k early. So I can't stress enough the importance of having an emergency savings. 3 to 6 months worth of living expenses in case the unthinkable happens. You need to have that amount sitting in a savings account. That way you don't have to touch this retirement account, because you may need $10,000 and you're going to pull out $10,000. However, after you're hit with all the taxes and penalties you're going to have to pay on that, even for a hardship withdrawal, it's probably not going to be nearly as much as you think you're necessarily going to get. So how much can you withdraw early? So you've decided you need to take a hardship withdrawal, you need to withdraw money early. How much can you take? Don't just think you're going to take it all. The employer may require documentation to show the actual financial need. So if you need to pull out money early, you may have to show what your actual financial need is, what that amount is, and you'll be able to withdraw that amount. Keep in mind you'll actually probably be able to withdraw a little bit more for the taxes and penalties associated with that, but generally speaking, you're only allowed to pull out the amount for the financial hardship that you may have to cover that expense. So what will pulling money out of your traditional 401k cost you? So you've decided you need to pull the money out even for financial hardship. You're under 59 and a half, automatically right off the bat, you're hit with a 10% penalty. So they're gonna take that. You're also gonna get hit with ordinary income tax. So if you pull $10,000 out, $10,000 is gonna get added to your ordinary income tax. You're gonna be taxed on that at the end of the year, so it's gonna raise your taxable income by $10,000. So even for hardship, you're gonna be taxed, you're gonna be penalized. So please be aware if you're pulling money out, it's probably not gonna be the amount that you're gonna expect to get. Also note that the IRS is gonna automatically withhold 20% for federal income tax. That's not actually income tax being paid. They're just gonna hold that amount to make sure you actually do pay the taxes on that when it comes due. So when you file your taxes, you may get a refund depending if they withheld too much. So are there any exemptions to the 10% penalty? And in fact, there are. So if you need to pull out money early, the IRS actually does define some certain things that you may be granted exemption from paying the 10% penalty if you need to pull out funds before the age of 59 and a half. However, be aware that you're not gonna get past those tricky income taxes. You're always gonna have to pay taxes anytime you pull money out of your traditional 401k. Some things that may qualify for an early pullout of funds and not have to pay the 10% penalty on are things like permanent disability, death, and transfer to a beneficiary, rolling over to a different retirement account, or perhaps maybe a divorce where you have to split the funds with a spouse or something like that. However, check with your employer, check with the IRS, make sure before you pull funds out and you think you're qualified for a 10% penalty exemption, make sure you actually are and you check that box before pulling those funds out, or you might be in for an unpleasant surprise. So you really need to take money from your 401k early, but you don't want to pay penalty, you don't want to pay taxes, so you're asking, is there any other option? In fact, there is. If your employer's plan allows it, you can actually take a loan against your 401k up to $50,000 or the fully vested amount, whatever's less. However, this amount must be paid back with interest over usually a 5-year period or somewhere in there, depending on the plan. However, the good news with taking a loan is if you're sure you're going to stay with your employer through that time and you're paying this back to the account, the interest paid on that loan, you're actually paying to yourself and back into your retirement account. Companies also don't penalize employees and they allow them to continue contributing to their 401k plans during this time as well. However, there is one downside. If you default on the loan, it actually converts to a withdrawal and the remaining balance is subject to the taxes and penalties just like a regular withdrawal would. So even though it's your money in the traditional 401k, you've put into it for years, you've contributed for years, you can't just leave it in there forever. When you turn age 72, the IRS is gonna make you start pulling it out. So the IRS has data tables on their website. You guys can go look them up. I'll put links in the description below. However, those data tables are gonna tell you how much you actually have to pull out on a yearly basis based on your age and your expected death and everything like that. It's real complicated, but I'll put the links below so you guys can look at them. However, just be aware that when you turn 72, you're gonna be forced to take money out of this account, even though you may not want to. However, the one way around this is if you're 72 and fortunate to still be working, if you choose, you may be exempt from this if you're with the employer who houses the current plan that you're enrolled in. So the employer match, this is one of the best benefits of the 401k plan. So most employers actually incentivize employees to contribute to these plans by matching a certain amount of the employee's contribution. So my employer, for example, matches 60 on 6. So what that means is they're gonna match 60 cents for every dollar up to 6% of my salary. So for an example, if somebody has a $100,000 salary, they have to put in $6,000 a year to get the full company match, which is gonna be 60% of that $6,000, which is $3,600. So I encourage everyone to contribute to their 401k plan, at least at minimum up to the company match, because you're getting free money from the company. There's nowhere else in the market where you're gonna get a free 100% return on your investment with zero risk. So the one downside to 401k plan is really the investment choices. They're really limited. So generally speaking, in a 401k plan, you're probably gonna have maybe 10 to 15, 20 max investment choices, a majority of those being target dated funds. So what a target dated fund is a fund that's got a date behind it. And let's say I'm gonna retire in 2040. So I picked the 2040 retirement date fund. So what that is just a collection of stocks and bonds and different assets. And as it gets closer to 2040, the allocation in that portfolio is automatically going to shift from stocks to bonds and less riskier assets. So these are generally popular for people who just want to set it and forget it. They kind of know they want to retire around this year, so they just put all their money into that. It's a good way to save for retirement. It's pretty diversified. However, if you want to be more actively managing in your retirement account, I'd probably stay away from the target dated funds. Some other funds that are in there are generally, you have some bond funds or stable income funds that are going to provide you with a steady stream of income, interest payments. You may also have equity funds such as the S&P 500, US small cap, US large cap. You may have international fund. You may have an emerging market fund. You may have, who knows, it's just kind of whatever your employer offers. Our employer actually offers company stock, so we can invest directly in stock of the company and buy stock of Raytheon Technologies. So it's best to have a diversified portfolio. We'll do a future video about proper portfolio diversification and stuff like that. But just understand that in the 401k, plans are pretty limited to 15 to 20 mutual funds at most. So in 2020, the US government passed what's called the CARES Act. And the CARES Act is to help people that's been affected by the coronavirus. And one thing that the CARES Act does, it actually allows people to tap into their retirement accounts early and not incur some of these penalties and fees that they may otherwise would have. I'm gonna go over a few of the highlights of those. If you need more information on the CARES Act, I'll leave a link in the description below for the website. There's a lot of information in there. You can go there, see if you qualify, and if you do, and you need to pull money out of your 401k, you may be able to do so and not incur some of the penalties that you may typically be subjected to. So I'm going to highlight two things about the CARES Act. So the first one I want to talk about is pulling money out. Usually when you pull money out of your 401k, you're subject to taxes and penalties and all that. However, this year for 2020, you can actually pull up to $100,000 out of your account early without being subject to the 10% penalty if you've been affected by COVID-19. Again, please visit the CARES Act website to see if you qualify for this, if you need to pull money out. However, if you do, you can pull out up to $100,000 and not be subject to the 10% penalty that you normally would in ordinary circumstances. Also, if you pull this money out, IRS usually automatically withholds 20% to set aside for federal income tax. They're not going to do that anymore. You get to choose when you pay the tax on this over a 3-year period. Now, you're still going to have to pay tax. You're not going to get out of that. Trust me, we'd love to, but you're not going to. You still have to pay tax, but you can distribute that either all at once or equally or in any way that you want over a 3-year period. So let's say you had to pull $15,000 out of your traditional 401k under the CARES Act. What you could do in this situation is you could put all $15,000 on this year's tax return and go ahead and pay the tax on that, the income tax. Or you can split that up over the next 3 years in even increments, or you can wait more towards 1 year, less towards another, to be able to provide you with the best tax relief possible. So this is one flexible tool that the government and the IRS is allowing you to use to be able to reduce that tax burden. So you actually don't have to pay the money back. You can use that money and it's yours to use for whatever expenses you need, whatever hardship you fell on. However, if you're fortunate enough to actually be able to pay that money back within 3 years that you borrowed from your 401k account, you can actually go back in and file an amended tax return and get all that tax back that you paid on those funds originally. So the CARES Act also made a slight modifications to loans. If you want to take a loan against your 401k program, you're now allowed to do up to $100,000 or the fully vested amount, whatever's less. In the past, that was $50,000. And this time they give you a 5-year period to pay it back. However, you can defer any payments till 2021. So starting in 2021, you have to start paying that back to yourself with interest, just like before. However, you can actually defer payments till 5 years down the road, starting in 2021. So those are the big two takeaways from the CARES Act for 2020 and how they affect early withdrawals from the traditional 401k for those who have been affected by COVID-19. So you've got your 401k, you like it, you got a nice healthy nest egg, and you found a better opportunity. You went to a new employer. So what do? In that situation, generally people have 4 options. The first one is pull the money out. It's your money anyway, take it, why not? However, absolutely not. I would not do that under any circumstance. Just pull the money out and keep it, put it in your bank account, because you're gonna have to pay the 10% penalty and you're gonna have to pay ordinary income tax on that. And if we're talking hundreds of thousands of dollars down the road, which hopefully we are, that's a lot of income tax. So don't do that. We definitely don't wanna pull that money out. The only way we can pull that money out is if we're over the age of 59, or we've become permanently disabled, or we meet some of the other IRS criteria for pulling that money out early. If you're wondering what those are, we talked about a few earlier in the video. You can go back and check those out, or you can check out the IRS's website. I'll leave a link in the description below. The second option, and my personal favorite, is to roll that money over into a traditional IRA, individual retirement account. This is the best option for those even who are retired, is to put that money into that retirement account, because you're going to be able to choose investments in that account and allow your money to continue to grow even through your retirement years. IRAs are also popular retirement vehicles, because usually when you set those up through a brokerage like TD Ameritrade or Schwab or Fidelity or something like that, you're going to have a lot more investment choices than you would in a company-sponsored 401k program. The third option, which people hardly ever do, is leave it with your current employer. I don't know why you'd do that unless they have a stellar program, which most of them don't. So I would cross that one off the list. I would never consider leaving it with my current employer. I would still roll it over into an IRA if given the choice. And the last option is to move it to a new employer. So this actually may be an option if you're younger, to move it to a new employer. And the only reason I say that is because if you're going to contribute a lot to this plan, you can already start with a large nest egg in your retirement account and go ahead and contribute to that more with your new employer, as it's going to compound and snowball larger and larger over time. Because if you put it in an IRA, the maximum amount you can contribute to that IRA every year is $6,000. However, the maximum amount you can contribute to the new employer's 401k program is $19,500. So if you're going to contribute a lot more and you plan to contribute a lot more, it actually may be a better option to roll it over to the new employer if they allow it, because you'll be able to get that snowball to be able to start rolling down that hill and compounding a lot larger over time, because you started with a larger amount and you can contribute more on a yearly basis. All right, guys, so hopefully you got a good understanding of what a 401k is, all the ins and outs of them, and hopefully you guys are armed with some knowledge now to give you some things to think about before investing. So if you have questions about 401ks, please leave me a comment in the link below. I'll be more than happy to help you with your personal 401ks, give you guys advice, guidance, anything like that. If you have questions, I also encourage you to give this video a big thumbs up if you enjoyed it. And also please subscribe if you guys want to see future investment videos, things about finance, personal finance, investment education, anything. This is going to be the place to do it. If you guys have a topic you want me to cover, please drop me a comment below. I'll be more than happy to do a video on that and help you guys really understand things to help you become financially free. So thanks, and I'll see you guys in the next video. Peace.